All right, everyone. So welcome back to class 3 for Settled Asian Real Estates for our 30-day buy home challenge. So this is our 3rd year of doing this. And this year, we're getting a little lazy. So instead of just me and Nelson just leading these classes, we decided to rope our friends in so we can double our classes. Smart, eh? So today, we're going to be talking about real estate tax strategies. And so, as an investor, you guys might make a lot of money. But the thing is, in the end, what's most important is how much you're able to keep at the end of the day. Because if you're going to be just paying to Uncle Sam all the time, there's really not much left in your pocket. You might be working a ton, but it's not going to show for it. So today's agenda, what we're going to be talking about is how to strategize to reduce your taxes in 2023. What are some changing tax rules that can affect your taxes, and about the short-term rental loophole that might be able to help you, especially if you're like a W-2 worker. So before, I'm too lazy to get my head out, but that's dentist over there. So we really can't do this series or any of the activities that we've been doing this whole year without thanking all of our sponsors for pitching in, especially for the SARE event and for Invest Now and all the field trips that we've done. So you're going to see them talk or a little, their icons throughout our series a little bit. So if you guys are thinking about getting a loan, definitely check out some of our sponsors first. And then also you'll see my beloved tax guy. Tax dude, actually, my beloved tax dude. Tony is one of them. So thank you. I love you. And he's also my CPA. So that was easier for me to rope him in. And that also shows that I have been using him and I've been a really proud customer. So I'm happy to recommend him to you guys. So a little bit of background about Tony. He is the founder of the CPA Dude, which is a tax firm that specializes in saving you taxes via real estate, entity structuring, retirement planning, and much more. He used to work at one of the big 4 companies like Uber and DoorDash tax department before venturing on his own. Tony is in the Bay Area himself, and I'm really not kidding because he's actually my neighbor. And his tax experts actually serve clients all over the nation. So even if you guys are not based in the Bay, he's able to help you. And a cool thing about Tony is that he has partnered with our other SARE homie, Davis Yu, an attorney in SoCal, so that they can both team up together to give you guys the legal and tax help that you need. So without further ado, I'm going to turn over the rest of this event over to our bestie over here, Tony. And then later on, what you guys can do is if you have questions, go ahead and drop them into the chat. We will have a Q&A session to answer all questions. So thank you guys. All right, Tony, you can use the share screen.
All right, and thanks for the intro there, Annie. Let me share my screen and let's make this happen. All right, so there's multiple ones. All right, hopefully this is the one. Can everyone see the screen okay? Good. All right, sounds good. Welcome everyone. Thanks for joining the session tonight. Gonna be talking about taxes. It's quite boring. Some people are interested, some people are not. So hopefully no one falls asleep. If so, it's recorded. All right, so we will be diving into it. But the first disclaimer here, everything is here for educational purposes. So everything that we're talking about is just for entertainment. Just have some fun. So if there's anything pertaining to tax questions, please do ask your tax advisor. Or reach out to us. We can help, guide you also. So just want to disclaim that now. Agenda, like Annie said, I want to talk about some foundational items, compliance items. I think the biggest one in the group that I've noticed is W-2 offset. How do I write off my W-2? Got a joke and a real strategy for you guys tonight on that one. Some alternative ideas to think about outside. More tools that you can have, planning, Q&A. Is going to be the agenda for tonight. And then feel free to drop questions in the chat as we go, make it interactive as we can be while we're on the topic too. So no stupid questions, like taxes, as stupid as it is already with the code, it's so hard to digest. So there's never any stupid questions in my book. All right, so I know that we're doing the 30-day challenge here, and I just wanted to make a quick slide in terms of just foundation, because I know a lot of folks are pretty advanced from who I met in the group, but also some other folks I met, they're just starting. They haven't purchased their first unit yet. So I'm going to try to cover as many folks as we can within here. So first, I want to talk about foundation for when you're doing your taxes. So, biggest item is, your write-offs. Everything that you write off is going to reduce your taxable income. So, what is a write-off? A write-off, simply put, in terms of the IRS, is what's ordinary and what's necessary and used to maintain the business. Once your rental, your flips, your agents, so that's what a write-off is. Very gray and subjective space. Don't get too creative though. Yesterday, they just filed the case and found a 15-year scheme with the Trump's orgs where they were trying to pay for their grandchildren's like tuition, nice car leases, Manhattan hotels and apartments. So don't get too wild off there. And the write-offs feed into bookkeeping. Bookkeeping, simple, boring exercise, but simply recording, your source of truth, whether it's which is your bank statements and your credit card statements, into some system of record. So that would be, QuickBooks, that's your Google Sheet. Just gotta make sure everything balances, and then make sure you coordinate everything. Coordinate / make sure nothing falls through the loops. I know a lot of people get caught up when it comes tax time, just scramble to get all the receipts. So not only for tax purposes, but I think you personally should be doing your books pretty, probably once a month, twice a month, just so you actually truly know how your unit's performing before you're too in the red, know how your investment is. Everyone does so much homework during, purchasing the rental, but I think bookkeeping gets left off and is kind of like the ugly sheep of taxes. Next part would just be your receipts. So from a receipt perspective, do you need a receipt? Do you not? Generally, we say you should have a receipt. I've seen IRS auditors where they will only take the receipt, and some folks will actually take the bank statement and credit card statement, but don't bank on it. The true source is your receipt itself. So those are cumbersome, super annoying. What I tell folks from an ease of use perspective is just go ahead, when you have the receipt, take a picture, drop into a Google Drive folder on the spot. Then in the case you're ever audited, then you can fire up that folder and search for your life then. So that's from the receipt perspective. And then bank accounts. So on bank accounts, what I mean by this is to, if you're going to use some tool like Stessa or QuickBooks, something that just connects with an API to pull in all your bank data, it would be a lot easier for you to have a dedicated bank account per unit. I mean, it's not, once you have a ton, yeah, it's going to get a little bit cumbersome. But just as, for the early folks that are getting in just to one or two here, just because I know the crowd's diverse, it will just make your life easier on the bank account. So, bank account ending in 3472 is for ABC 123 Main Street, and then account ending in 8888, is for, 246 Main Street. So that way you can easily separate it, and then you'll have that separation. And then probably the most famous question that gets asked, and consult with Davis on this, is do you need an entity? So entity formation, do you need an LLC? That's always a very common question, and it depends. So it depends being whether, how much risk are you willing to tolerate? So, if you're broke as a joke, don't got really many assets, and just got the one home, you don't got much to lose. But, if you're, crazy rich Asian, got, 2 million in equity accounts in your 401k, got the home, with a, decent amount of equity in there, you're probably better off, getting off an LLC. But always, just talk to a legal pro on that. And then also, for the other folks in the group too, if you're, within an agent space or property management, even if you're really like all in Airbnb, not just on the side, look into other entities also. So from a corporation S election, you can S corporation, you're able to save a lot on payroll taxes that way. So if you're active on top of hustling everywhere else, because I'm sure everyone here is hustling pretty hard, to get these fat down payments to buy the homes. And these different ways to structure yourself from an entity perspective really can save a lot on taxes. So that's the foundation part. Just wanted to go over, just the 101s, the basics, just so you're going to need track your write-offs. You're going to have to do your bookkeeping. You're going to have to track receipts. Banks optional, but it's a lot easier to go through one small bank account that has maybe 20 transactions versus going through your own personal credit card statement at year end and trying to sift through everything. And then, yeah, entity, it depends on if you need one or not. Right, let's see here. Then let's drop into the comment. All right, Annie, so it says, if we put properties into the C or S Corp, will we lose out on tax savings like the 1031 exchange? So C and S Corps and LLCs all are eligible for 1031 exchanges, but generally, for passive income, you do not want to put it into C or S Corps. And the reason why is because these are subject to active tax rates. So S Corp, you have payroll taxes you have to issue for yourself. C Corps get taxed at 21% on the federal level. So yeah, good question there. But yeah, a lot of times too, I've seen some folks that put into a C or S Corp, and it's passive, probably get it out of there. Okay. All right, nice little button here. All right, oh geez. Transposition didn't come up pretty. All right, all good. All right, so compliance. So just want to talk about compliance 101 also. So depending on how your units do, 9 times out of 10, if it's just a long-term rental, midterm rental, and you do have a mortgage on it, probably you don't need to pay quarterly estimated taxes. But, if you are operating Airbnb, we have seen those actually be positive for tax purposes, actually, even after depreciation, mortgage interest, insurance, all that fun stuff. So do pay in quarterly estimated taxes. The tax system is a pay as you go system. So what that means is that as you earn the income, you have to pay the taxes on that income. And those quarters are actually really weird. They're like 1, 4, 6, and 9. So January, I was thinking like numbers. So January 15th, April 15th, June 15th, and September 15th are the due dates for your estimated taxes. So weird quarter way, but just make sure you get it in. Otherwise, there's an underpayment penalty and interest will be assessed. And for that, like the last couple of years, they actually didn't assess like any estimated tax penalties. I think it's because the IRS is so backed up. But this year, now that the IRS has like caught back up, like they're actually issuing these notices again. So you're actually subject to these. So don't ignore these. These are almost not as important as your annual tax return, but it's still important. Just silly money to pay the IRS. And then of course your annual tax returns. So if you're a partnership, multi-member LLC, S Corp, that's due 3/15, so March 15th, come right around the corner. And then your personal return and your C Corp, due 4/15. Unless it lands on a holiday or the weekend, which I think this year it does. So a few extra tax days for us procrastinators. So that's your annual tax returns. If you do extend, I still want to, call this part out from the extensions. So simply put, an extension only gives you more time to get information. It does not give you more time to pay. So all the money is due 4/15 no matter what. So do be very wary of that. Just don't think like, oh, throw down an extension, I'll pay it up later. If you do miss it, you're going to have, underpayment penalty and then a little bit of interest due on that side. So just to clear the air on there, I think that's probably one of the biggest myths that people get confused with. And then 1099s too. So on your rental properties, a ton of 1099s need to be issued to your contractors if applicable. So there's literally a box on your Schedule E that says, did you file all your 1099s? And that's due end of January, actually. So what you need for that is make sure you get your W-9 from your contractor, know how much you paid them, and then issue that out by 131. You can either use online software to file this, or you can also use, you can order the 1099 NEC forms from the IRS. Probably takes like a week to get, but they're free. So I just want to be, how thrifty we are on that side. So compliance, really boring. No one likes it, but just want to make sure the due dates are clear, extensions cleared out of the air from you don't get more time to pay. Taxman always gets his money. So then moving into the W-2 offset. So I think this is probably bring some life back into the group here. So if you're a W-2, what are the ways that you can offset your W-2? And there's not a ton you can do. Like when you're W-2, like you're pretty like hands are tied behind your back or in handcuffs, hence why I found this image. Besides doing the low hanging fruit at work. So maxing out your 401k, if you have an option to do the mega backdoor Roth 401k, do that also. And then, HSA, FSA, those type of benefits, pre-tax parking, pre-tax anything. That's pretty much what the gimmies are at work. The reason why it sucks to be a W-2 for tax purposes is that the employer is bearing all the risk. So they're the ones getting the good fat deductions. So what can you do? So what you can do, become a real estate professional. But if you're a W-2 and you're just solo single right now, you're not going to be able to. Kind of like another myth is that if you work 750 hours, you'll automatically qualify. And that's not the case. There's the second prong that you have to meet. And that's the more than 50% of any other activity. And that's where most people fail this one when they're single. So that's why generally how you can unlock being a real estate professional is either that's your career as an agent, property manager, or, the more tried and true one is just one of the spouses is the real estate professional in the relationship. So you got the high, I don't know, tech job, like when we're on the Bay. Well, I'm in the Bay at least, but got the high tech job with stock-based comp, the high RSUs. And then you got the other person, they can probably just become the real estate professional. So one person can go get loans while the other one's managing the portfolio. That's the most tried and true way of doing it. So as we always joke in this group, marry a real estate professional. The next part is the less than 150K AGI. So harder to meet in high cost living areas. So California, New York, not that applicable, but when I used to live in Minnesota, that's where I'm originally from, this actually worked. So what this is that simply put, you're able to offset passive losses against active income because you make less than $150,000. This starts phasing out at $100,000 and simply means that for every $1,000 that you make over, you lose half the deduction there. So it's up to 25K max per year that you can take. But yeah, if you make less than 150K AGI, this is, another way to offset some income. So, and then lastly, the biggest one I think would probably be most applicable to, the group and who, a lot of folks that I've met would be your short-term rental loophole. And your short-term rental loophole, simply put, if you haven't heard about it yet, is probably one of the best ways right now to offset W-2 income and build your portfolio. And so what this is that you have, a short-term rental, you put it on Airbnb, VRBO, you have your own listings on your Instagram page. And the first quirk that you need to meet is that it has to be an average of 7 days or less. So you can have 2 30-day stays, 4 15-day stays, and then like 61-day stays, as long as the average stay is 7 days or less throughout the whole entire year, you'll meet prong number 1. And then prong number 2 that you need to meet, there's 7 of these little prongs. You only need to meet 1 of them. And that would be probably the most applicable ones would be you worked 500 hours on the property or 100 hours and no one else worked more than you. So simply put, you wouldn't have a property manager. And then number 3 is the really gray one, super aggressive. It's you substantially performed all the work. So there's no hours required to it, but it's very gray. So if you do take that prong, I would pray that that property is really close to where your address is. So those are the 3 most common ones that you need to meet. So once you have those 2 prongs met, Then what happens is that you run a cost segregation study on it. And then for anyone on the call who doesn't know what the cost segregation study is it simply is just paying some engineering firm a few $1,000 to give you a fancy report that tells you, hey, in this house, we have 3-4 different types of property. So by default, a residential unit is 27.5-year useful life. However, bonus depreciation doesn't apply for anything greater than 20 years. So that's why you need a cost seg study to make sure you can extract what's 5-year, what's 7-year, what's 15-year property. Because then once you get that report, they'll separate it all out. And that's how much bonus depreciation you can take in year one. So what that would mean is that everything that you take, boom, year one, all that will be considered an active loss for you, and they'll plug against your W-2, and you'll get, pretty much a big reduction on your AGI, and then more or less get back all the taxes that you've been withholding on your whole entire paycheck. So that's the short-term rental loophole. It's pretty good for a lot of folks that are stuck in the W-2 world. So if there's any questions there, definitely this is a massive documentation exercise, more aggressive too. So if you do execute it, just be in store for a potential audit, maybe just because the ratios it may trigger from the IRS may not be that great. Okay, and then Annie says, oh, that's hard to reach the average. Lots of math required. Okay, all good. That's good old spreadsheets. Okay, and then Eddie, you got your hand up, my dude?
Yeah, I got a couple of questions, so bear with me here. The first one is, to qualify as a real estate professional, can you, let's say, be on paternity or maternity leave for a year and just be a temporary real estate professional during that time while you get paid a W-2 to qualify?
So would you have both the W-2 and the paternity leave, or
Well, let's say
one?
my wife, she has a kid and then becomes an active real estate agent during that time, but she's collecting a paycheck through her employer because she's on maternity leave while I'm getting paid with my own W-2. Would we both be able to take the real estate professional status?
Oh,
Even
yeah.
though she's collecting the W-2 income.
Yeah, that's still fine. So if it's like reduced, so one, you hit the 750 hours, but the biggest thing would be number two is the 50%, over half your time is dedicated toward that one activity. So yeah, you can have, say, a side W-2, and if more than 50% of their time is truly spent on, developing, managing real estate, then you'll be able to take the real estate professional status. I do want to caveat that, if you take it in 1 year, we generally like to see folks take it in year 2, just before, in the case of an audit ever happens, before it gets disallowed, just because you'll have it on 1 year, off the next year. It does look a little like more suspicious, and the real estate professional status it has a higher chance of audit too. So that's kind of where you just want to caution on, hey, is the amount of extra depreciation write-off against your active income going to be worth it?
Okay, sounds good. And then question number 2 is the 150K AGI. Does that increase if you're married?
No, that's the worst part. It's like 150K whether you're single or married.
It's kind of terrible. All right.
Yeah. Because everything else doubles. Like the standard deduction doubles when you marry. Like I don't know why this part of the code's so broken.
Okay. And then another question is, this is more on the federal level. Is there additional qualifications for the state level that you had to go through, or does the 150K all that set at the all levels?
Oh, so this would just be 150K on the federal side. It would be also state dependent too, though, because generally, so states always start at federal AGI, and then they modify per the rules. So there's additions and subtractions per each state, and then also need to watch out for bonus depreciation. So some states don't recognize bonus depreciation, like California. So you'll get a fat federal benefit, but then California are just on the hook, and yeah, we're in a great state. Yeah.
Okay, got it. And the last one, I have one more. The cost seg timing, does it have to be in the year you purchased it, or at least like the following year within the tax period, or can you do it like 10 years down the road?
So both actually. So the cost seg, so say if you bought it, you're like inspired and you go buy property tomorrow, all cash. So then you don't have to run the cost seg study like this month. You can simply just extend your taxes and then you'll have till 10/15 of 2023 to have that cost seg report done. So that would be the easiest. But the second part is, yes, you can always get a cost seg study done when, like, say you're like, oh, year 3, like, I'm like, oh, I just learned about this sweet tool. I want to execute on it because I'm a real estate professional. I want to accelerate my, depreciation. You can do that. You'll just have the change of accounting method, the 3115 form you have to put on your taxes. And then you possibly may be in store for an audit. It's just these certain forms just trigger, like, have a higher chance of getting audited, but it's fine. I mean, you have the cost seg report, you did it correctly. It's not to be aware of. I always just like to brace people for the repercussions.
Got it. All right. Thank you.
Yeah, for sure. Good questions, man. All right. We got Jen, you got some questions?
Yeah, so for the rule for like 51% for the hours, if, like, how do you count the hours? If, let's say, I'm contractually supposed to do, X amount of hours, but I actually put in a little bit more, like, do those count?
Oh yeah. And then this is for the real estate professional, or are we talking about the short-term rental loophole?
For real estate professional status.
Yeah, so real estate professional status. So say if you work a part-time job, right? So you work a part-time job, not 2080, but 1040, right? 1040 hours per year. And then you like do real estate full-time, like 2080 hours. And then so from an hour requirement, you would meet that, right? So technically, yes. But then say if you're like, you want to have a life and not work 3,000 hours, you work 1040 hours as, your side gig, and then you worked 1,100 hours as managing your properties. And then your true intent, like your true living, actually comes from being a real estate professional, and that's substantially all your time, then you could still meet that rule.
But what if I have like multiple part-time jobs?
Oh,
Plus
that's fine. Yeah. So if you have multiple part-time jobs,
Mhm.
all the hours will still add up, but is it, how many hours total in real estate are you?
Okay.
Yeah. So your denominator would be all jobs plus real estate. And then your numerator would be real estate hours. And then you see if that's going to be that 50% fraction or not.
Okay.
Yep.
Thank you.
Yep. All right.
Hey, I got one more for you. So when you create an entity, let's say you're a real estate agent, right? And you have rental properties, should you create another entity for each business?
So one for an agent and then one for your business, or your rentals. Yeah, definitely create separate ones, because generally during an agent, we want to see you as an S corp, just because you'll be able to save a lot more on payroll taxes. And then when it's your passive income, keep those in LLCs, just because you don't want that subject to payroll taxes. So multiple, and then just, are you in California? Where are you at yourself?
Yeah, I'm in Cali.
Oh, okay. Then yeah, just get a lot of 800 LLC fees. Yeah. Pay to play. Hey, but it's free this year, next year. So if you open up a LLC in the last 15 days and you do 0 activity of the year, you don't have to pay the 800 LLC fee. And then there's a slight nuance to for next year, just because like Newsom was trying to promote like more businesses. Next year is the last year of a wave of the 800 LLC fee in the first year. So take advantage, do some work, my dude.
I will. Thank you. That's awesome.
Yeah.
Hey,
Alvin,
Tommy.
you got a question?
Yeah. Hey, good to see you again.
Oh yeah, what's cracking?
So there's no benefit at all for this real estate professional thing if you make over 150, right?
Oh, sorry. This when I converted this from Canva to PowerPoint, the bullet points got messed up. So the real estate professional status, it doesn't matter how much you make. You can make $1 billion, you can make $100. It doesn't have an income cap.
Oh, for sure. Okay.
Yep. The less than 150K AGI, that's like it should be a second bullet point, but
Oh, okay. Got it. I was thinking like,
transposition went bad.
okay. For sure. For
Mhm.
sure.
Yep.
Okay,
Mhm.
cool. Thanks.
Yeah, for sure.
All right, sorry, one more one to squeeze in there.
Oh
For
yeah.
the short-term rental loop, can you literally just buy like the crappiest short-term rental there is, even though you're making like, let's say, over 150K and claim a real estate professional status if you are spending a lot of time in that business?
Yeah. So like if you took an example, so say if you're like, you're W-2, $500,000, and then, good old software engineers, and then you're like, all right, I'm going to go do a short-term rental loophole. So what you do, you're like, cool, beat down property down the street, just going to like work on it as I please. And then you bought it for 800,000, run a cost seg study on it. We've seen that about 10% is kind of 10 to 20% is generally a building value. So say you get an $80,000 benefit. This is like a real life example I'm using. So, but like, yeah, you'll get $80,000 of extra bonus depreciation. And if you're at the 500,000 mark, between federal and state, that's probably about 33%, 30%. So 80 times 0.3, that's $24,000 that you just saved there versus paying it to the government.
Okay. And then does the entity kind of come into play? Because if, let's say, you have property in your short-term rentals in an entity, but you're trying to offset your personal W-2, which is, your own self, like, does that affect anything, or that just crosses streams and that's not a problem?
Won't be a problem if it's in an entity LLC. Yeah, LLC. Yeah. So it'll be a different answer if it was a C corp or S corp. But yeah, I think if we learned anything tonight, don't put your passive income in an active business such as an S or C corp. And then that's actually a good point I forgot to mention earlier is not putting or not, sorry, you don't need an LLC to get all the write-offs. So I think that's a common myth I hear too, like where folks think you need an LLC to take the write-offs. You don't. You can just put it on your Schedule E on your personal tax return. So just to clear the air on that one too. I just want to just make sure we cross all the don'ts, the big no-nos off the list. Yeah. Miss Annie. Uh-oh. Oh, you're gonna ask something bad.
no,
I'm gonna leave now.
no, it's an easy one. It's one of
Uh-huh.
Christina's question, and it's a question that yeah, you clarified for me personally, and it made my butt hurt. So it was really about what do you define as the real estate professional, like the type of work that they do. For example, Christina, she works at a real estate tech company, but she also manages her dad's rentals. And for me, I've been running SARE, and you're like, you don't qualify for real estate for that, even if you have a license. So that sucks. But how about like lenders or contractors, plumbers? How do you define that? That's basically real estate.
Oh yeah, like by definition, actually listed like in the code. I can't remember exactly off the top of my head, but it's generally like if you're a developer, you're managing, like you're an agent. Those are like the three most common folks that we serve that actually have the real estate professional status. But I feel like there's four more. But no, that's a good one. We should like find the full list. It's like right in the code. It literally says like what these are the activities that you can do to become a real estate professional. So just for jokes, or actually it wasn't a joke, it was actually real life, but Annie and I were like, oh man, could we spin, Annie being, the SARE, guru admin here as, a real estate professional, but, it didn't meet one of the 7 definitions. Like we kind of concluded she's more of an influencer than anything.
I don't know if I should feel insulted, but technically you're right. I don't do real estate.
Yeah.
But how about like say for example, Danny Wong, he runs like 4 cabins, all the Airbnb, and he does all the bookings and stuff. So it's really kind of more than the techie side, but can that count?
Oh yeah, so not for real estate professional, just because the other quirk, so he probably for sure throws down hours. He's into it. And then, but he'll fail on the prong of, is it over 50% of his time? Is that his true intent? So it can almost be as easy as an example of like, hey, I sit on these chats for like 3,000 hours a year talking about real estate, but like my true service and my true intent is actually tax. So you have to always so like in the audits, they'll always boil down like, hey, what's your intent is what they want to see. So you said for Christina, yeah, if you're in tech, if you're in tech, but it's like real estate tech and that's your primary job, depending on what your role is there, if it doesn't meet one of the definitions, then you wouldn't qualify.
Sorry, techies. All right, there's a question from the Facebook Live from Sharika. She asked, I just created my S Corp in September. Do I need to make a payment on January 15th, as you mentioned? And how would you calculate that? Because she doesn't use QuickBooks.
Oh, yeah. So you made an S Corp. Hopefully it's some type of active income. And so on the federal side, so an S Corp is a pass-through entity. So simply put, S Corp sits on top. You're as one of the shareholder owners. All the income passes to its owners. So the federal side does not, you don't have to pay anything, but the state side, you have to pay 1.5% of your net income. So if you don't use QuickBooks, so just pull up all your revenue and then pull up all your expenses and then see, say if that's 100,000. So then just multiply that by 1.5%. So 1,500 on that side. So that's on taxes due by 115. And then also, if that's the case too, you do need to pay a personal estimated tax too, because we said it's a pass-through entity. So what that means is that you won't be taxed at the entity level, but you'll be taxed as the personal individual level. So on that $100,000, you'll probably treat it as a distribution unless you pay yourself a W-2. And then that distribution is subject to income tax. But when you take the distribution, there's no mechanism to withhold taxes. So that means you just have to pay in enough too. So say your effective tax rate is 24%, 25%, you just have to pay in 25 grand on this $100,000 example. So that's estimated taxes there. They're no fun, but it's this name of the game. But also that's actually a good thing for everyone to note. So if you're doing quarterlies, one, just do it on yourself just to know. I see a lot of W-2s go astray where there's not enough income being withheld. And then if we have a lot of techies in the group too, since almost everyone in the Bay gets paid with stock-based comp, generally the withholdings are actually not enough. So federal withholdings, so back when I was at Uber, we got RSUs there. Federal minimum is 22%, but you may be in a higher tax bracket. So you could be in, say, the 32% tax bracket. So then you actually have a delta about 10%. And usually you don't find out until 4/15 when you go do your taxes and surprise, surprise, a fat bill comes. So another reason why you want to do that, but also why I say you want to do estimated taxes quarterly on yourself is just to be like, hey, Q1, I owe this much. What can I do to reduce that? Like, just don't pay it all away. Like, you should start strategizing and think about ways of how you can do it. Like, hey, short-term rental loophole. Oh, cool. Like on that $800,000 purchase price of a home, $80,000 is what we saw on a real life example. I mean, $80,000 to offset. I said that was about 24K benefit. Could really move the needle on for you. So it'll help fund your down payment or help at least fund your furnishings. So just be more strategic about your taxes. I think that's, we get a graveyard of folks that just generally just come to us because their old CPA didn't like provide them guidance or strategy. And I don't blame them. It's just like, hey, there's different types of games. It's like, hey, come in, pump, dump the returns, see you next year type of deal. So yeah, just be more strategic about your taxes. Like truly have, I say, a tax plan is kind of like a blueprint to your house. It's like a workout plan to your workouts. Like you need some type of direction. Like, I don't care if it's plain Jane, like pay estimated taxes, buy one long-term rental. Cool. Like that's going to help you versus just having zero. I had a really OG professor back in college, and she said, some estimate is better than no estimate, even if it's completely wrong. And like, I laughed back then, but then like, you can kind of see your point now. So just, long old story. Alvin, you had a question too?
Yeah, I did. So let's say hypothetically that like I'm really good at my job and I'm able to do like 40 hours worth of work in like 2 hours. So I'm working 2-hour weeks. And then I spend the rest of the time working on real estate. Can I qualify for like a real estate professional, like on the side? Or like, because I sort of saw somebody say that if you have a W-2, you can't get that designation. Can you elaborate more on that?
Oh yeah, no, that's Man, that'd be interesting. Yeah. So I feel like this one actually probably get furnished out in the like under if it were ever to get audited. But
Yeah.
if you like truly tracked your hours, like say you got one of those like nice jobs, and then you're just like, hey, you get paid 40 hours for 2 hours of work.
Yep.
And then you track the hours you worked at work truly, and
Yeah.
then you like double down in on real estate, you still can qualify 750 hours doing, say you're managing or developing or, gathering deals, one of the prongs, right? And your true intent is real estate, you can still qualify. So
Okay.
say, for
sure.
example, as a real estate professional, right? A lot of our agents, they're S corps to start with. They have a fat W-2, usually 20 to 40% of their net income. And just because you have a W-2, it does not automatically disqualify you from that.
Okay.
I think that's a common myth that I see. I feel like there are some also more OG CPAs, a little bit more conservative. But as long as you have the documentation, that's your biggest thing for this. So you could still pull it off.
Oh, for sure. Okay, cool.
Yeah.
I'll follow up with
Mhm.
you more later about that.
Sounds good.
Okay,
Sounds
thanks.
good. Mhm. All right, cool beans. So, let's check out the chat items.
There's one from Wilson in the chat for STR loophole. If he has one STR, for example, a crappy one, and 10 LTRs, long-term rentals, does the passive to active offset only apply to the short-term rental, or is it all 11?
It would only be the one short-term rental. Yeah. There is this, I haven't actually, this is a good follow-up too, though. Like, so there's this item called grouping in the tax code, and I wonder if this would apply actually. So what the general concept is that you can group and have the same treatment for all your properties. So I wonder if this could be one. So more of the tried and true case of like how this is used in the current like example is that generally you have a business owner, that's an S corp. You have an LLC that owns their brick and mortar commercial store. And then that LLC also has properties under it. And the general election, the grouping election here is that you can group this one rental to be completely as a commercial unit. You can group it and elect it to treat it all the same treatment. And there's a quirk in tax code that says that if you're a business owner with your own unit, own building, these losses over here on the commercial side can offset the active income from your business. So that's actually interesting. Well, like, one second, I want to write that one down just to see, because that's a good, like, if you could unlock a grouping strategy on one STR to 10 STRs, like that would be wicked.
Well, hey, Tony. So
yeah.
I wonder if the intent of the question is if you can get an active real estate professional status through a short-term rental property and then take the depreciation from all the other 10 long-term rentals and apply it to your W-2. I think that's kind of what he's alluding to.
Oh yeah. So that gate would only be open to one though. Yeah. So you would only so you can kind of think about like so all rentals are by default considered passive income. And then there's this one gate, and this gate can only be unlocked by a real estate professional less than 150K AGI in that short-term rental. So on that one short-term rental, you're able to take those losses because it's just treated as an active business. So this like the whole short-term rental loophole like comes from like code section 168, like happened in the 1980s. And it's actually made for like bed and breakfasts because like they're treating these as like real businesses. And then you're able to offset because you're a real business, active business, you're able to take active losses too. So that's kind of like where it comes from. Oh, and I forgot. So if you're one of those like super jolly chipper folks that actually interact with your guests, there's this other thing called substantial services that has the short-term rental quirk to it. So if you truly like, say, if you cook food for them, you like drive them around, or the tour guide, or like you go in and clean for them, where you're truly acting like, I would say the best analogy is like you're truly acting like a hotel. You actually can bypass all the hours. So it's like one of the 7 prongs or substantial services. So that's another thing I forgot to mention on the short-term rental loophole. So yeah, but I think most people don't want to interact with their guests, but just in case we got chipper folks in here. All right. Let's see. Was that everything that we had there in the
There's
question?
also Eddie was asking about the real estate professional, about like you can account if you're a property manager, but say pretend, one of our sponsors, Specialized Property Management, they own a giant company and they hire their property managers and they're paid as W-2 employees. Then in that case, can they still qualify for REP status?
Oh, I see. I see. I would say no on that because you're missing the intent again. So the intent that you're missing on here. So technically, I think by definition, you would meet it, but the intent part is where I would caution away from it. So the reason why it's your intent. Your intent is you're actually working for another company who provides the property management services. Your intent is not actually doing the property management for yourself or for your own properties. So that's where I would lean against that side.
Great. And then Christina asked if the short-term rental loophole can apply to midterm rentals.
Oh yeah. So yeah, your answer is good there. And yeah, so if the good old math equation works out, so if you like midterm rentaled it for maybe like we'd have to do the math, but like however many, like as long as you can meet that 7 days, so maybe you midterm rentaled it for, I don't know, 6 months of the year. And then the last 6 months of the year, you went like, hey, weekend stays, 2-day stays only. And it all added back up. So it'd be stays divided by days, or the vice versa of it. So which one is that? Whatever the fraction is on the spot. So that you could still meet it technically. You just have to have that many short stays though.
Cool. So Christina, if you ever do get that, midterm rental and you want to invite me and Nelson over to New York and you want to balance those, we could book one day with Nelson and one day with me, we'll help you out with that.
Oh, nice. New York. Okay. Oh man, it's late, isn't it? Over there, 9:52. Yeah, it's late over there. Nice.
Well,
Okay.
he hangs out with West Coasters.
There you go.
All right.
The
Next
cool
question
kids.
is from Joe Yang. If a house is co-owned, can the mortgage interest deduction apply to just one person?
Oh, this is a good one. So the mortgage interest, it's so generally you do want to tie it back to whoever's name's on the 1098 that they issue. So if both your names are on there, then you would each be able to say, if you both paid for the interest, then you take 50% each. But there's a quirk in this too. Say if your name is not on there, but like you kind of indirectly own it because you funded the down payment or something like that, but your name's not on title for some odd reason, the tax rule is actually whoever pays the benefit actually gets the tax deduction. So what I mean by that is like, say mom and dad own the home, right? It's still in their name, but you collect a rent, you property manage it all. You pay the mortgage interest. You can actually take the mortgage interest. It doesn't tie perfectly because it's not on the 1098, but as long as you can show the proof on it, that's why the first slide, the compliance, the documentation is so important. And then the other quirky thing here is mortgage interest on, we're going to primary homes quickly, even though we're talking about investing, is that, so say if you got your primary home and the mortgage is say $1 million, but it's owned by you and your partner that are not married, right? So the mortgage cap interest is $750K. So traditionally you would lose out on that extra $250K of your mortgage. But because you're not married, you each can actually take past that amount up to 1.5 million. So that's a small quirk. We just see it a lot because it's Bay Area, no one gets married quick, but buy homes and dogs together. So that's another quirk there for folks. And also on a similar derivative of that is that if you buy a very expensive home, that's your primary, and you're like single, you can actually hack this by getting 2 750K mortgages. So you wouldn't be subject to that cap. So if your loan's 1.5 million, you're subject to 750K cap. But if you just go get 2 loans at 750K, you still meet it. So yeah, small tangent there. Good question though. I like that one. Cool. All right. Let's see here. I think we're good on cues. Facebook's good on cues, Annie.
Yep.
Cool. All right. Let's see what else I have in here. I don't even remember. Oh, here's my joke. So my joke, my really bad joke, I'm terrible at this, but I say alternative to your W-2 is quit your job. Is just because W-2s, like in the previous slide, you're handcuffed to the tax code. You know, all the benefits go to the employer. So what I say is start up your side hustle. So this is a half joke, half advice thing here, is that, hey, if you actually like take your skill set of like what your W-2 is, and can you find side jobs on Upwork, TaskRabbit, you know, all these freelance companies, Fiverr, these marketplaces, and start replacing some of your W-2 over time until you can build up enough of that to walk away, right? So that way you'll get the benefits of being an S Corp, pay way less taxes, write off, you know, a lot more of your lifestyle, and you just get way more of a write-off perspective. So half joke, half truth. And then this is appreciated assets. So this is another alternative. So this is since kind of like, you know, when Annie asked me like, hey, what in 2023 can you plan for? I feel like deals are harder to get right now. Interest rates are high as hell. You know, I just hit up, well, one of Annie's sponsors, Absolute Mortgage, right? So I was talking to Anthony, and then I was like, yo, dude, like DSCR loan rate, what's it sitting at? And it was like 8.75 to 9.5. And I was like, oh, like, you know, your numbers got to be pretty spectacular to that. So in the meantime, you know, how else can we tax plan? There's this Art of Taxes calculator that I have up here. And simply put, this is similar to appreciated stock or land conservation easements. So if folks don't know those two concepts, simply put, you bought an asset at X amount of dollars, it's appreciated a lot. You donated it to a charity, you actually get the charitable contribution at the fair market value of donation. So through land conservation easements, I do not recommend this right now. It hit the IRS Dirty Dozen list actually, because it's just being super abused. But generally what it is that you have a fund that you go pitch in 50K, you invest 50K into it, and then this 50K just turn into 500,000. And you just donate that 500,000. So the land gets donated to the government and you get the write-off. So more of a controlled way of doing this, more legal way that's not flagged is through art. So we have a company that we partner up with, and you invest in art. Takes over a year to approve to do because you need to show economic substance. But in this example, oh, this is actually someone from SARE. Actually, so they made over $500,000. And, you know, we kind of rounded up their tax rate about 33%. So here they invested $40,000 in art, that 39 number, and it gets appraised at 4x the value. And they get appraised 4x the value. You get $157,000 deduction in the following year. So what that means for you in this tax bracket is that it's actually worth $52,000, but you spent 40. So you're getting an ROI of 12,600. So you actually made money. So just another way to think about taxes is through charity, right? So I always tell folks the framework you want to work in for taxes is always deferral, right? 1031 exchanges, opportunity zones, acceleration, bonus depreciation, charity. You can actually donate your home to your own trust, actually. So that's another can of worms I'm trying to learn right now. But it's like a legal strategy, apparently. So, or donations to this charity or business or real estate, right? So we're touching on 3 of the 4 of those items here. So this is another big way to save. Generally, like I just reserve this strategy for the classic tech bro, software engineer that doesn't want to invest in real estate. But since return items ROI right now is, at least I can't find a single deal. That's good enough. This one's returning 32% ROI. So alternatives to W2. I always just I think a lot of folks from the group here are W2. W2s are great, but hey, they're not tax advantaged. So, all right, into the questions here. Okay, co-owned, live off loan. There you go. That's another way to do it. I like it. So Eddie, so for the 750K mortgage interest deduction cap, should you file separately from your significant other if your loan is above? So the quirk goes away when you're married, though. So it's like when you're when you're still not married and you bought the house with your partner is when that hack works still. Then Annie turned SARE into a nonprofit. Nice. Donate your home expensive stuff there. Nice. I like it. That's your way out, Annie. Yeah. All right. Cool beans. All right. Let's see what else we got left in this puppy here. So other tools within the real estate world that you guys can use for your strategies is the homeowner's exclusion. So this is section 121. Simply put, you hold you lived in your home for 2 of the last 5 years, then you're able to exclude $250,000 if you're single, $500,000 if you're married. And this is kind of a missed area, not missed, but maybe less informed in the community, is just the partial exclusion. So you can trigger a partial exclusion, right? So say if 24 months and year 1 in, say you went to SF and they're like, cool, move on out and then we'll put you up, blah, blah, blah. And then you're like, oh, something happened to the company. And they're like, hey, I need you to relocate to Austin, Texas, another tech hub. And then you're forced to sell your home. You can actually take a partial exclusion because you were forced to move for work. There's some other prongs. I think it's like natural disasters or like bad family health. There's a few of the quirks to it, but the biggest one that we always use is work. So that means, say in this example, right, you were there for 12 months and the exclusions for 24 months, and you're single, instead of getting a 250K exemption, you still are entitled to 125K. So it's not a complete, you're lost if you sold your home. So that's the partial exclusion. The 1031 exchange. So 1031 exchange, simply put, is just selling your current property. You're able to go upgrade and, spend at least the same amount, if not more. And then all your, gains are deferred until you sell that property. But what happens if you don't? So you say you don't reinvest all the funds. It's called boot. I actually don't know. These tax terms actually don't make any sense now in hindsight when I speak out loud. So it's called boot, and it simply means any leftover cash that you didn't reinvest is subject to tax. So 1031 exchanges, using that to your advantage there. It does have time limits, so you got to be ready to go, act on the gun if you're going to do that. Plan properly, for sure, if you're going to do a 1031 exchange. Opportunity zones, a cousin sister product. So what an opportunity zone is that you open up an opportunity fund. So it can be a simple LLC. And this fund, its core mission is to invest into opportunity zones. So you can sell your home, put the gains into this fund, or this actually works for stocks too. So you can, well, stocks suck right now, but say we're in last year, you had a big gain and then you sold for a fat gain. You're like, oh, I don't want to pay taxes on it. You can defer this into an opportunity fund. And now this opportunity fund can go buy property in opportunity zones. Opportunity zones, where are these properties? They're designated census tract properties that the government wants you to invest in to kind of revitalize that area. So lack of better words, more ghetto areas. So they're just trying to increase the economy there. So opportunity zones, a good way to defer your income. And then also if you hold for 5 years, I believe you wash away either 5 or 10%. And then the next 2 more years, you wash the other 5 or 10%. I think it's 10% the first time and then 5% the second time. So you could lose 15% of your gain actually. So ways the government is trying to kind of promote their own causes, but give you a tax break. Tax loss harvesting. So this one actually applies for this year. So tax loss harvesting, fancy tax words again to simply say, sell your bad stocks. So it's positions. I'm not a financial advisor, but just saying if you see that these positions are never coming back anytime soon, you don't care to hold on to it. Like myself, I have crappy Uber stock still. Could probably just sell it, take a loss, and write off some against my taxes. But how you compare this with tax loss harvesting is that if you had a big capital gain in 2022, say you sold a property, you didn't 1031 it, you didn't opportunity zone it, you just wanted it because you wanted cash, you're able to sell off all your bad positions and offset that gain from there because these are both capital gains. So that's where tax loss harvesting could actually make sense. I don't generally recommend it because technically you are losing money. But hey, if it's never coming back, you don't have a good outlook. You're like super day trader before, and then you found SARE. Now you're like super like real estate professional person. Could be a change of portfolio for you. And then last part, the cost segregation study. I think we went over this already, but simply just running a report. So cost segregation study, actually had an earlier client call today, and we were kind of planning for the future. So he is not a real estate professional, not short-term rental, loophole. Why would he want a cost seg study, right? All we're doing is we're paying, a couple thousand for a report to accelerate his expenses, right? So you'll change a lot of the property into 5-year, 7-year, and 15-year property. So at least you're increasing your depreciation per year. But we were actually planning for when his company IPOs in 2 to 4 years. So we're trying to bank in all losses right now, get bonus depreciation year 1. So then when his wife becomes a real estate professional, because they're just planning on having a kid and she's going to retire and become a real estate professional, will unlock this fat bank of losses that he's going to have when they IPO. So many ways to use all these tools. I've specifically named this tools because these are just items that can be used. It's just everyone's fact pattern is so different for taxes. You just have to pull the right tool out at the right time. And then is there any cool way to stack these tools at the same time? So this is kind of the other tools. Take a drink of water. All right, cool beans. All right, let's see. Christina, does your partial exclusion count if you quit your job for a remote one, but just want to move to a cheaper area? You're a very creative person. I don't know who you are, but you're a very creative person. I like it because the creative folks actually kind of give me some ideas on how we can go for it. That one's a hard one. I haven't seen it, but it's worth a research cause because job relocation is one of the prongs that the IRS gives you. So maybe I'll throw you it depends, but I'll write that one down. That one's interesting to research. I'm a nerd, so I like to research stuff. Partial exclusion. I'll just copy paste. All right. Zoom doesn't let copy paste. All right, one sec. Partial exclusion for moving for a remote job on your own will. Okay. All right, cool beans. Mercedes has, if I only stayed in my primary residence for 6 months of the year, other times I rented out as an LTR, MTR, would that 6 months that I'm away be counted towards the 2 out of 5 years? So you actually have to live in the property too. But as long as you lived in that 20, I would probably count the months though. So we've had folks where they'll live in it for a year, rent it out, come back again. That's why it's like of 5 years. So you don't actually have to have like a consecutive 24 months. You can have 24 months in general. So that could still work for you. And then Annie owned multiple rental properties. I wanted to sell one property, then do cost seg studies for the rest. Can the depreciation offset of my long-term capital gains? Yep, correct. Yeah, so that's similar to your cost, the tax loss harvesting here. that you're doing. So that would work for you there. Then Dennis, jump off. Cool. All right. Sounds good. Have a good one, my dude. All right. And then I think, I don't think I have that much more. So we got planning. So yeah, tax planning, like I mentioned earlier, have some type of tax plan for yourself and execute on it, right? Hold yourself accountable. It's what we do for our clients. We sit down, drop a tax plan, check in every so often on if we're actually doing items. But a lot of the group here, pretty smart folks in terms of like, hey, how can we shelter more taxes, right? Everyone's funding real estate through different activities, whether you have your W-2, you got your business, how can you, utilize more of the tax code to your advantage? So for the folks that are more in a deduction audit world, do you know what's a write-off? Do you not know what's a write-off? So on your rentals, as your agent, as a business, do you know what you can write off? If not, do a deduction audit with like a tax pro. Sit down and just see like, hey, are any of these expenses that are in my personal statements technically business expenses? Like if I know that you're writing off on the business, 9 times out of 10, it's probably correct. But on your personal side, that's when I know you could be missing some. So doing deduction audit, funding your retirement accounts now. So your, self-directed IRA could probably be a good one for everyone here if you want to go pair into real estate. Your vehicle write-offs, just another, quick tip, that's because, the bonus depreciation phasing out 20% each year going forward. So this is your last year to get the, big G-Wagon on that side. These are more travel. So in this travel area, what you can do here is that you can loop in some of your travel on your Schedule E. So what you could do here, if you don't have a business and you're just a W-2, you could write off your travel on your Schedule E to visit your properties. So another way to kind of prorate, double dip into the tax code. Life insurance, I think, Sarah, Annie, you had Peter on, right? Before to talk about life insurance to pull out and invest in real estate.
Peter?
Was it
Like,
Peter? Oh, I can't
you mean
remember.
Rick who? Rick who?
Oh, Rick. Yeah, it was Rick. Yeah. Yeah.
Mhm.
So for whoever missed that one, but essentially what they do is that they help you fund life insurance policies, and they essentially front load your initial investment, and then you're able to start pulling out the principal and the gain to go buy properties, and it's tax free. So that's how the life insurance part goes in with the tax code.
Infinite banking, you mean? That's the term for it.
Infinite banking. Yeah, that's always an interesting one. I still want to sit down and follow the infinite loop one day. Yeah. And then there's the Augusta rule. So simply state some tax-free income for everyone. So if you want to rent out your home 14 days or less in the year, you're able to do that, and none of it is a tax expense or taxable income for you. You don't even have to put it on your return. So if you just want to slap your home up for Airbnb for 14 days, be my guest. And then if you actually have a business too, rent out your own home with the Augusta rule. Do be cognizant of making this, market rate. I got sent a TikTok by one of my clients, and they're like, they sent me the Augusta rule, and then this guy was saying, oh, he wrote off $14,000 from his taxes. And I'm like, yeah, may not apply. Maybe for him because he's like a high time influencer, and yes, he probably lives in some fancy LA like apartment that goes out for $1,000 a night. But generally, you want to peg how much you write off to the fair market value of what your property is, or your one night stay at your property is worth. So just be wary of that. And then income shifting. So income shifting being said, like say if you're in an Airbnb or you have a business, they're both profitable. What I say by income shifting is paying your mom or dad, your sister, your broke ass friend, like that doesn't have a job, like shift them $12,950 because they will pay zero tax on that if they don't have a job. And then you get almost a $13,000 write-off. So this is just income shifting, and then mom and dad just kick it back to you anyway. So it's just another mechanism of, using your taxes here. So yeah, that's planning. Just very important on this side. Sit down, get some tax plan, put some chicken scratch on a piece of paper and execute on it. Then let's hop into questions here. Okay, did we already talk about the qualifications needed to use cost seg, accelerated depreciation? 500 hours spent on the business would probably be best if you have a partner. Oh, no problem. Yeah. So we talked about the short-term. I think you're talking about the short-term rental loophole. Oops. Yeah. So the short-term rental loophole here is that, yeah, right here, what you need on this, just to kind of brush over it, would just be, yes, you do need the cost seg on it because you need to be able to separate your 27.5-year property into 5, 7, 15-year buckets. And then from there, average of 7 days or less. So as long as the math adds out to 7 days or less, you'll be able to qualify. And then we also said you could bypass the hour requirement if you're like truly acting like a hotel. So that's not substantial services. And then 500 hours spent on the business, probably best if you have a partner. So this 500 hours, you do want to peg it to one person. So if you went into this with a group like of friends, whoever has the highest taxable income should take this because the tax write-off and the dollars are more effective at their rate. So the 500 hours should be that one person though. So good question there. And then Eddie, can you deduct vehicle expenses from your W-2 if you're a realtor? Probably not going to meet the rep status though, and I don't have an LLC yet. My man, yeah, yet. All right, I like that forward thinking. So if you're a realtor, you can deduct this on your Schedule C as a sole proprietor. So every mile that you do drive is actually worth 56 cents. So 100 miles adds up pretty fast. So yeah, you can take it on Schedule C though. Do have a mileage log. So I tell everyone, get Mile IQ, QuickBooks. They also have their built-in mileage log in there. So just track your mileage though, because you need to know business miles versus personal miles for IRS purposes. Right off the children, there you go. Give them Roth IRAs. Yeah, I wish our parents did that. Probably none of us would be here if our parents just put in Roth IRAs since we're kids. All right. Alvin, you got a question?
Yeah. Hey, so this is regarding income shifting.
Yeah.
So like I know that if you have your own LLC, you can write off like losses for 2 years, maybe 3 years if you shut down the LLC on the 3rd year.
Yeah.
So let's say I shift like my earned income from my W-2 to like my mom or something.
Yep.
And then basically I can deduct that. It basically goes to the K1, right? So then basically it just reduces my tax burden on the W-2, right?
So generally what we say for this one is to throw it through a kind of like a family management company on your Schedule C. So say you start up a side hustle and
Sure.
then you pay, either the kids or the family through that Schedule C.
Okay.
And then you 1099 them that way.
Gotcha.
And then the Schedule C will pick up a loss, and that
Yep.
loss will net with your W-2 up top to finally get to your AGI.
Okay, gotcha.
Yep.
Okay, cool.
Mhm.
Thank you.
Yep. Just don't, I think the biggest quirk on this is to, I know a ton of, the OG agents are on like the good old like Medicare food stamps. Just make sure this doesn't bump them out of that program.
Okay.
Is the other thing.
For sure. Thanks.
Yep. Cool. All right. Joe, are there any tax benefits of having trust owning the property? So for tax purposes, they're all the same? So a trust would be your pass-through entity if it's in there. So it'd still pick up as rental income. So a trust, an LLC would not make any tax difference versus a Schedule E. So all the same there. But speaking of the devil, you should have asset protection in place. So hit up Davis after this and go bug him. But he, definitely have your LLC with your trust, because the bad joke is that nothing's guaranteed but death and taxes. So one, you always have to file your taxes. Two, unfortunately, one day we will pass, and versus having it go through probate forever for the will, if you don't have a will and all that fun stuff, just have it in your trust, especially everyone that's here. If you're investing into the real estate, I mean, give it back to someone in the family at least, or the homie, versus just letting the state fight and all everyone's coming after it. So definitely bug Davis to get your trust set up. Speaking of which, I need to take my own advice there and get my own trust set up. So Davis will have a conversation. Short-term rental question. Would you be able to use the average customer usage of 7 days or less to qualify? No hours needed. We're looking to split the cost seg depreciation. Average customer usage of 7 days or less. Would you be able to use the average? I think so. You can always, so no matter what, you need to do 7 days or less to qualify. So that's prong number one. If you want to bypass the hours, the hour bypass rule would be either one, that third prong that I said that's pretty hyper aggressive is you substantially did everything for the property. So that one does not have an hour requirement, and then you'll still be able to qualify. However, if that property is probably not within driving distance, a reasonable driving distance for you, with where you live, that rule probably won't work. So how that rule works is that, say if, I'm in Richmond and I did a STR in SF, right? Very believable, right? For me to go substantially do everything. But if I have an STR in Tampa, right? No one's going to buy that. So have it close to where you're at. Or else the other prong that we joked / are actually serious on is the actually acting like a hotel. So being their chef, cleaning their rooms every day, acting like a hotel, being their tour guide, that type of area. Lock Davis in. Okay. Jonathan says locking in Davis. Annie, there you go. Nice. Good stuff. So that's good. Christina, for RE syndications, the active income from asset management is taxed at my gross annual income rate. Correct. Passive rental income can offset passive losses from K1. Yeah, so the buckets that you need to stay in here is that you have active buckets. So active income, offset active losses, active income. And then passive, correct, is passive K1s, passive income is how you can offset. So that's another way of how it all gets washed together. So say if you invested into a business as a silent investor, it actually produces profits. And you have another investment into properties with a friend and it has a passive loss, those two would net. So yeah, active, passive. And then also just more on the topic is the capital gains. So short-term capital gains can only offset our short-term capital losses. So those have to stay the same. Long-term capital gains offset long-term capital losses, but long-term capital losses can offset some of your gains, short-term gains. So just for those three buckets. Okay, Tenzing, is the substantial activity the best option? What would you recommend to qualify if there are partners trying to use the cost seg? If you can meet the substantial activity, yeah, I mean, it's just easier. You don't have to document the hours. Logging hours is kind of a, pain in the butt. And then if you have multiple partners trying to use the cost seg, so if it's an LLC, possibly, if it is, then it just roll into one. But if it's not in an LLC and this is going to go on, like I said, just put it on one person's return. Okay, if you're going to use that too.
If it is on an LLC, so what do you mean by roll into one? So how do you qualify? How does the LLC qualify? Then like we just need that 100 hours or like 500 hours?
Yeah, so on the LLC, so to qualify, so it is in an LLC, and I would just allocate for this year. I would just allocate that all to one partner this year, and then pick up and then shove back the tax gain, like the taxable savings, to the other partners that way. It'd be easiest to flow. Yeah. Okay. Yeah. But if it was like hypothetically, if it's like very, if it's not like that, right? It's not investment with the homies and, got some other random parties in it, then what you could do is that you can just split the cost seg So it'd be pro rata per person on their benefit. And then the person who actually did do the 500 hours, 100 hours, or substantial services, they would be the only person entitled to it. But then you're losing some of the tax benefit.
Okay, so it looks like the best option would be just only one person will be able to actually use the
Yeah.
class. Right?
Yeah, exactly. Yeah. The person with the highest taxable income or tax rate would be the most useful of it.
Is Chris on this? No, just kidding. Sounds good.
Nice, nice. Cool, cool. All right. Good question there. And let me see. I think, oh, all right, cool. Q&A, and yeah, I think we got some good Q&A in here. So if there's any other questions, speak now or forever hold your peace right now.
So Tony, how do SARE members slide into your DMs or contact you if they have more questions or want to work with you? Are you taking new clients right now?
Oh yeah, so I got that fancy slide here. So pretty much everything. Oh man, PowerPoint transposition is terrible. So the website's thecpadude.com. My email's tony@thecpadude.com. Instagram and TikTok are the CPA. Everything's the CPA dude. The phone number is 928 CPA dude. So send me a text there. It's not actually you can't call me there. I won't pick up anyone's call anyways. You can ask Davis that. So unless it's on the calendar. So everything's the CPA dude if you want to find us. And then yeah, lock you in and get your service right, protect some dollars from Uncle Sam. Alvin, you got a question too?
Yeah, I have one more question. So let's say I have hypothetical. Let's say I know like a lot of homeless friends or whatever that have zero income, and then I do like income shifting for the entirety of all like my W-2 income. So I give 12,000 whatever to each one of these employees. So after I do that, right, and I do a schedule 1099, 1098 or something. Oh no, I'm gonna get my money back. But okay, let's in this hypothetical, right? I'm gonna get my money back. But basically, how would that work? Because that means like if I am able to basically income shift all of that money, right? What's gonna happen? Do I have zero income on that? And then like when they send that money to me, will the banks flag me because I'm basically like receiving back like my entire like all that income for the year? Like would that even work in this scenario?
So you would well, yeah, depending on how rich you are for everyone. So it's like you would pick up a fat loss on your Schedule C.
Yeah.
So that Schedule C would pick up a fat loss. Pray to God you got some income. So start up some side hustle before you do this. So you
I have an LLC right now. That's kind of like just tossing around the idea. I'm not gonna do that because I feel like I get audited, but maybe like a portion of it.
So yeah, you would pick up some income, subtract out all your write-offs here, your 12,950 to each person. So say you did this 10 people, 130 grand.
Sure.
And then you pick up that 130 grand against your W-2, subtract it out, probably get a lot of your tax money back. And then in terms of recycling back the money, so a what is it called again? Is it a flag transaction or reportable transaction?
Sure.
Yeah. So that's if it's 10K or more, and it's usually, so that's in one sitting, or if it's, they actually monitor it like even within a 60-day period. It's like what I learned. So just be careful on how you're like recycling the cash. But if it comes through payment processors or like Zells or Cash Apps, because it's already in there, they actually don't consider that reportable transaction. So it's like generally when it's cash at the bank or money order wise, it's when it flags it. It's also not like the end of the world. This is actually just more so just to deter like drug dealers actually. So it's they just flag it and they'd say, hey, where's this money come from? Like, oh, here, it's just my W-2 income. Like, oh, this is like my my convenience store. I have all this cash from there, have the receipts, here's my return. So it's not like a big deal. It just gets flagged because they're just trying to look out for drug dealers.
Yeah, because I feel like there's like a business strategy here, right? Because we can just like recruit homeless people on the street or something. There's
a lot. There's just for shits and giggles. There's so there's this one strategy. We don't execute on it. You got to be like,
Yeah.
I'm not that rich. So like you need like multi-million-dollar businesses here. So like $10 million plus businesses. So if anyone that is that rich on this call, this may be applicable to you. But generally, there's the family office strategy. So the family office for folks is that you have this family office that conducts certain activities such as billing. Generally, it's for like physicians, right? Billing, companies charge anywhere from 10 to 30% of that. So they'll bill their own family office 10 to 30%. So this next one went on steroids is that this family office is actually set up in Puerto Rico. And Puerto Rico has preferential, like way better tax rates than, sit here. So you go send this family office your management fee, they pay federal taxes on that side, and then you get back the kickback. So I haven't done it. I've learned the concept, learned a company who does it, but I mean, I haven't ran into a client that rich yet.
Yeah, I'm not there yet. That's why I kind of want to
Oh,
capitalize
actually, this is hilarious because I was talking to Tiffany last night, Miss SARE lady host, and then she was talking about finding investor, like someone, a Puerto Rico resident, and if we could execute on this. So buy the properties, rehab, sell, wash the capital gains with the investors, get the preferential tax rate over there, and then send the money back. But then we're like, what if
get the money back?
Yeah, what if you don't get the money back? Exactly. Yeah, we actually talked about that last night. That's funny that you bring that up. Yeah.
Yeah. Well, one of you guys can live there for 6 months of the year and then you kind of qualify.
Oh man, I'm spoiled, man. Bay Area, not moving. Perfect weather. Don't have to leave the home. Yeah.
Yep.
Yeah. All right. Cool beans.
Thanks for answering the question.
For sure. What else we got in here? A dog that asked. That's not nice. Would California require you to have workers comp for those employees? If we're talking about the income shifting ones, those are actually contractors, so you wouldn't have to on that side. Unless we're talking about if they're normal employees, yeah, you need workers comp. Oh, also fun fact too is if you have 5 or more employees in California, now you're required to provide some type of retirement program. So if anyone has 5 or more employees in California, watch out for that compliance rule too. More of a payroll thing. I'm not a payroll guy, but just happen to know that quirk because I have one person here. Cool. All right. Let's see here. Mercedes, I might have missed this. Can I write off car leases if I'm not real estate professional? So possibly, good old it depends here. But if you're pretty active within your, like, say you're running from house to house to house in your truck, then you're like doing all the maintenance, you could write it off on your Schedule E. If not, pick up a side business of some sort and just have a Schedule C and write it off there. So you need some way to write it off. So whether it's a C or E is generally how you can get away with it. Cool. All right.
Excellent. So, everyone, Tony's based in California and he does have a lot of California clients. So if next year our treasury funds go down, you can blame this guy. It would be his fault. Just saying. So just really want to thank Tony for his time to teach us all of these, because the reason why I had switched over, working with accountant to actually working with a CPA with someone like Tony was because no one would teach me any of these type of things. I didn't know how to ask these questions or what to ask. So it was really helpful that I got to work with Tony and bring him to you guys, because, if we work with other CPAs, they're going to charge you like by hourly for these questions. So it's really awesome that he can do that for us for free. So which brings me up to my next point. I kind of voluntold a couple of my homies who are in here, aka Tony and his homie Davis, to do more of these type of sessions for us later on. So I came up with this stupid idea on the fly, and I was like, I'm just doing, you guys are going to do mandatory volunteer work for me. So we will be starting a new series in the new year called It Depends. I literally just made it up this weekend, and I volunteered Tony and Davis to come back once in a while to do these type of Q&A sessions for us so that you guys are able to ask more questions. So This is the end of week 1 for our SARE classes for our 30-day challenge, but it doesn't end yet. We do have another 3 classes that are coming up next week. So next Tuesday, we have a class 4, which is going to be on partnerships and scaling up. Because at some point, you really can't buy everything yourself, or you don't have the knowledge to do so, and you might want to partner with someone more experienced than yourselves to work it, or it's just difficult because, for example, Tenzing partnered up with Chris because it's too much work for one person to do it. So 2 brains are better than 1. But once you start entering these type of transactions, there's a lot of red flags and there's a lot of things that you have to consider when you're working with other people. And then also for partnerships, you are able to bring in your funds together to take on something really, really big. For example, buy like a large multifamily together. So we're going to be talking about that, how to scale up, differences between a GP and LPs, what are differences between fractional ownerships versus syndications, or RITs or REITs, and how to look for partners. Because there's something that you guys have to understand. We are in SARE. We have 18,000 investors, real estate investors. So we want you guys to use our community to find other like-minded individuals where you guys have, similar investment strategies, and partner with them to take your investments even bigger in real estate, because we work better as a team. We can do bigger things when we are all together. So hopefully next week's lesson will be interesting for you guys. And so thank you, everyone. And I'm going to see you guys next weekend. Appreciate it. Talk to you guys soon. Bye-bye.
Thanks, Amy.
Thanks,
Have a good
Tony.
one.
Thanks, Tony.
Yep. Take care, guys.